Do you feel like a dumb ass trying to time the market using indicators or technical analysis? Are you tired of watching these YouTubers claiming to make thousands of dollars, but never making clear whether they have skin in the game or proving they can make profits at all? If so, this video is for you. But before we get started, let me tell you these three things. First, I invest my own money in all the strategies I do. To prove it, I make all my trades publicly available to you in a web app that I built, and that has all the trades and results for this strategy. Second, the strategy is very simple, and you can implement in your own by only doing one thing every day. Moreover, I'm going to provide also to you free access to the bot I built that automated the trade for me. Now, let's get started. Unlike every other strategy or trading bot that you can find on YouTube or the internet, the strategy I'm about to present to you does not rely on indicators or technical analysis. We will only use probabilities. This particular strategy has delivered over 400% over the last 3 years, with a total win rate of more than 65%. So what is this trading strategy? The trading strategy I'm going to use today in this video is called the covered call, which involves buying an asset such as Bitcoin or Ethereum and simultaneously selling a call option on that asset. The goal of this strategy is threefold. First, beat Bitcoin's return over time. Second, to generate additional income from selling an out-of-the-money call option. And third, to reduce the overall volatility of my trades. And by volatility, I mean that I want to reduce the ups and down swings of my P&L. To implement this strategy, I'm gonna use a Python-based bot that runs on Deribit exchange. However, you can do the same strategy in any other exchange that offers options, and you can execute the trades yourself instead of using the bot. I just use the bot because I'm lazy and I am not always able to be in front of my computer. For Deribit, I like it because I believe they have the most liquid option markets. And liquidity is king when considering trading options. Let's gonna dig deeper on what a covered call is. As mentioned earlier, a covered call is the simultaneously purchase of the asset, in this case the Bitcoin, and the sale of a call option. The end result of this strategy is very similar to holding a Bitcoin, but instead of having unlimited potential profitability, you cap the total maximum profit of your trade. Let's see an example. Let's assume you bought one Bitcoin for $30,000. In this trade, the maximum you can lose is the $30,000 you paid for the one Bitcoin. And you have a potential unlimited upside. So if Bitcoin goes to 1 million, you're gonna make $970,000. Now, you will sell one Bitcoin worth of call options against your current BTC position. The strike price for this call is $32,000, and you sell it for $3,000. For this particular call position, what you have is the following. The break-even point it is $35,000, which is a strike price plus the premium you received for the call you sold. And the max profit is $3,000 if Bitcoin closes below the $32,000 at the expiration date. But remember that you have two positions, so you need to combine or add them together to be able to calculate the overall position's P&L, which will look like this green line. As you can see, by adding them together, two things happen. First, you cap the total maximum profit you can make in the trade, which can be calculated as the sum of the strike price plus the premium sold the call option for minus the current BTC price. In this case, it will be $5,000, which is the $32,000 of the strike price, plus the $3,000 of the premium received, minus the $30,000, which is the current BTC price. Second, your break-even point is reduced by $3,000 to $27,000, and this is now the maximum amount of money you can lose in the trade. As you can see in the green line in the graph, you shift upwards and to the left your P&L profile, capping your maximum gains and reducing your basis or break-even point. Let's compare now the two positions. One long Bitcoin and the covered call. If Bitcoin stays between $30,000 and $35,000, the covered call will make more money than only holding the Bitcoin position. If Bitcoin were to close above $35,000, Bitcoin position alone will make more money than the covered call. But the covered call will still gain $5,000 in profit. And if Bitcoin is to close below the $30,000, the covered call will be profitable as long as the Bitcoin closes above $27,000. And if it closes below the $27,000, the Bitcoin position alone will always lose $3,000 more than the covered call. So you may be asking now, why would you ever cap your total profitability and keep the downside risk? This is where probabilities come to play. Let's say Bitcoin is trading at $30,000 again, and you have a covered call strategy in place with an option expiring in the next 5 days. What is the probability that Bitcoin trades at either $0 or $100,000? Very low, right? And in fact, when you have a liquid options marked, you can calculate or estimate the probability of both events to happen. And this is the game I'm playing. I'm selling the call, collecting the premium for the sale, and let the probabilities run on my side. If Bitcoin explodes in value, the strategy will still make me money, but not as much as if I were only to hold the BTC. But if BTC loses value, the strategy will reduce the overall losses because of the premium I received. By implementing this strategy, I am increasing the overall probability of making a profit by giving up the unlimited upside profitability. And this is what a covered call is all about. Let's take a look on Deribit options chain and learn how to implement this strategy. Here we have an option chain with expiration date at 12th of May 2023. Currently, BTC is trading at $29,360 US. In the center of the screen, you have the strike price of the options. In the left, you have the call options, and in the right, you have the put options. In green color, you have the bid price, and in red color, you have the ask price for both calls and puts. I'm not gonna go through the details of what options are in this video, but you can learn more about it by clicking the link below I provided in the description. For now, we need to know that an out-of-the-money call options are all the call options that have a strike price above the current BTC's price. And an out-of-the-money put options are all the put options that have a strike price below the current BTC's price. We will not be dealing with put options today, so let's focus on the call options. Look on the calls. We can see that the call option with a strike price of 30,500 has a delta of 0.35. Again, I'm not going to explain what the delta is or what Greeks are in the options model. What I'm going to tell though is that the options delta value is approximately equals to the probability of buying that option and make money. In this case, the 30,500 call option has a delta of 0.35 or 35%, which means that if you were to buy that call option, you would have approximately 35% chance of make money and 65% chance of losing money. But remember that on a covered call strategy, we sell a call option. Therefore, we would have 65% probability of making money and 35% chance of losing money if we were to sell that call option. Let's look now in the first out-of-the-money call option, the 25,500. The delta of that option is 0.49. Therefore, if you were to sell it, you would have a 51% chance of making money and 49% chance of losing money. So what is the difference between selling the 29,500 and the 30,500 strike price? The difference, it is about the trade-off between receiving a higher premium versus a higher probability of make money. Let's compare the two trades now. In principle, when you hold the BTC, you have approximately 50% chance of losing or make money in any given time frame. And if you have a covered call, you have a higher than 50% probability chance of make money because of the premium you collect for the sale of the call option. Another important thing is that every time you sell a call or put, you receive money for it. And if you keep doing it many times, you're going to keep reducing the overall costs you paid for a Bitcoin, until to the point you can claim to have a free Bitcoin. Let's take a deeper look on this strategy. Historically, on Deribit, it is possible to sell the first out-of-the-money call option with 1 day to expiration for something between 0.5% and 1% of the Bitcoin's value. You can check these numbers on the web app I built, and you can see that on average I was able to collect 0.073% for the last month. Therefore, if you sell every day a 1 day to expiration call option, you can basically collect between 200 and 360% of premium per year of BTC's value. This is just insane. In fact, I did run the numbers and back-tested the strategy, and if you were to do it since 2020, when Deribit first released its 1 day to expiration option, you would have returned 100% more than Bitcoin did, and you would have made 400% on your money. You can check the back-tested results of my analysis on the week section of the web app. As a result, this is what my bot is doing, selling every day the first out-of-the-money call option with 1 day to expiration. The bot also places 2 sit-in orders at a higher strike price, just in case Bitcoin appreciates more than expected in any given day. So what do you need to run this strategy? Essentially, you only need to buy Bitcoin some exchange, transfer it to Deribit, and sell the call option every day. But, as I said, I'm very lazy, so I did a bot to do it for me every day, and I'll make another video where we'll go through the steps to install and run the bot. But if you want to give a try on your own, you will need open an account on Deribit and create an API. Click on my affiliate link below if you still do not have one. Go to GitHub and download and install the Python code provided in the link below. Set the bot parameters according to your preference. And fourth, run the bot. You can run the bot using your computer as a server or having it online. I personally use Python Anywhere, as I think the learning curve is very low. However, you will also need to have a paid subscription, as the free version does not accept to access external servers. Once you set up the bot, it will run every day at 8 AM Universal Central Time and sell at market price the first out-of-the-money call option and place the 2 sit-in orders at a higher strike price with 1 day to expiration. On the next day, the call options will expire and the process will repeat, and the bot will keep placing more orders every day, repeating on and on the process. What are the strategies you can use with the covered call? Essentially, a covered call is a hedging strategy. As such, you can choose how much you want to hedge. Go to the web app I created and scroll down to the week section and then click on what is a covered call. At the bottom, you will find a graph and you can play with it with different hedging options by changing the number of call options you're going to sell against a 1 BTC long position. Let's take now a look on the bot performance by going to the web app I built. This is the web app I built. On the left side, you can choose the time frame you want to make the analysis for. As you can see here, the bot started running on 31st of March 2023. Below, we have all the app sections, so you can just jump wherever you want to go. Let's go to the center now. The first thing you're going to see is the main bot metrics. The most important indicator is the bot's performance over BTC. And as you can see here, for the time frame we're analyzing, the bot has returned 32% more than Bitcoin did. As of today, the bot has returned me 6.65% against the 5.03% of Bitcoin. Overall, I have made 0.001 BTC, and my total equity in this particular account is 0.077. Overall, the bot has 22 winning trades against 34 total trades, with a winning rate of 64.71%, and it is running for 36 days. The next section is the last trade executed, where you can see the date when the bot last made the trade, the instrument used, decide whether I'm buying or selling an option, the quantity, and the price. Then you can see the cumulative gains of the bot and the BTC over the time frame. As you can see here, most of the time the bot overperformed the BTC, and as of today, the bot has a 6.64% against of a 5.05%. On the cumulative gains covered call bot over BTC, you can see by how much the bot is over or underperforming the BTC. In this section here, you can see the gains for different time frames. As we can see here, we're seeing the daily gains, okay? Then you can see the weekly gains for BTC and the bot. So the bot is running its 5th week. We can see the gains for the month, for the quarter, and for the semester. And of course, it's the same returns because we have not still run more than 2 semesters. Then we're going to show here the cumulative P&L. This is how much BTC the bot has returned. Remember, on Deribit, we deposit BTC, so all the gains are measured in BTC. Account value, how much BTC the account holds today, and how much that translates into USD. So you can see here, today we have 0.0776 BTC, and that translates in almost 2,259. In the strike price sections, I present here the strike price for all the calls I sold over the time frame. As you can see here, each one of the bubbles has the strike price and the amount of calls I sold against it. As I only sell 0.1 calls against my position, all the bubbles have the same size. But you can see here how the strike price has changed over time, and in the red dotted line, you can see the average strike price sold for all the calls, which is 28,817. Premium received. This is a very interesting graph, and here I'm presenting the premium received as a percentage of Bitcoin's price. On average, I was able to sell every single call for 0.73% of the BTC's price. Hedging returns. This is a graph that shows what your return would be if you were to overhead, hedge, or underhedge your position. As you can see here, each one of the lines represents different hedging percentage, where we can go from 100% hedge, where for each long Bitcoin you short 1 Bitcoin call, to a 10% hedge, where for each Bitcoin you only short 0.1 BTC. And you can see here that the best result as of today is when you hedge 100% of your position. I just would like to make one more comment here. If we scroll up to the bot metrics, what you will see here is that my total equity is 0.07765 BTC, and I'm selling a 0.1 BTC call option. So essentially what I'm doing here, only when you compare to this particular account, I'm over hedging my position, meaning that I'm selling more call options against my current BTC holdings. But that's not really true because I have more BTC somewhere else. So in fact, I'm not over hedging, I'm under hedging if I were to consider only the 0.1 BTC coin that I sell every day on Deribit. Continuing, we have here all the commissions I paid for the trades I did. And important to mention that all the numbers you see here are after commissions are paid. Okay, so they're all net profits. Next section, it's the list of trades executed by the bot, and you can see here the currency, the date, the instrument, and every single other important information for you to see the bot's performance, to run the calculations on your own. If you scroll down here, you can see all the trades, and you can even download them. Okay, so this is where we are, and as you can see here, the last trade, the second last trade the bot did was on 5th of May by closing to buy the call option with 29,250 strike price. And if I go here to my account, as you can see, here we have how much BTC I have. And if I go to transaction log, you can see here that on 5th of May, I have closed, sorry, this one here, on 5th of May, I have closed to buy the 29,250 call option with an expiration date of 5th of May. The bot has already sold a new call option for 6th of May. This call option here has not been captured by the web app yet. And on the bottom here, where you can check information on how the bot works, what is the advantage of the strategy, what are the bot's input. But I would like to focus here in these two last sections in here, where we have what a covered call is and simulation with past data. If you click on what a covered call is and scroll down here, you're going to see this graph where essentially you can simulate for your own how the position would behave if you were to underhedge, overhedge, or just hedge. So what we have here, we have 1 BTC in this red line here and the covered call. And if you change the numbers in here, you can see how your overall position changes in blue line if you were to underhedge, for instance. Okay, so if you have only 0.1 called sold against your one Bitcoin, this is what it looks like. Okay, you would make a little bit less money if Bitcoin were to explode one day. But if you were to hedge, so this is what the graph would look like. So no matter how much Bitcoin would go up, you would still make money. And if you were to overhedge, then essentially if Bitcoin were to explode in price, there is a point where you start losing money. So you can see and you can check for yourself how this strategy works and what would be the best according to your sense of the market and your risk appetite. And in the last section, we have the simulation with past data, where you can go through and see how I execute this simulation and check for yourself the results of this strategy since 2020. As you can see here, in February 2020, Bitcoin was traded just below $10,000. And as we move forward here, as we get in 2023, this strategy would have been worth today $55,000 against $28,000 price of Bitcoin. So this is all I have for you today. I'm going to keep the bot running. The web app is going to keep updating. I hope you have enjoyed the video, but please click on the like button, subscribe to the channel, and keep watching. Thank you.